Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better understand what we see and on the global landscape. We continue to see deterioration in the Eurozone, the UK, Japan came out this morning with basically horrific export numbers. Their economy is greatly slowing. A lot of that has to do with what's happening obviously in the Eurozone throughout Europe. Greece obviously still falling apart, small country, but still falling apart. In fact, their prime minister is going to talk this morning, basically begging for more time and more money. Spain has not come to the table and said, hey, we want a full-blown bailout, and they will not go to concessions that Angela Merkel from Germany really wants to see on this bond buying program. Mario Draghi, basically head of the central bank, if you want to say, over there, talks a big talk, but so far nothing has happened now in over 4 weeks when he came out and said he's going to do whatever it takes to keep the euro together. Remember, you've got 17 countries in that, and everybody's basically has to agree, and this takes a lot of time. I believe we're up to 23 meetings since this whole euro crisis started 2.5 years ago, and nothing has actually been resolved at all. And all it really has been is more kicking the can down the road. That's a little frustrating. The emerging markets is primarily China. We've seen data coming out that, of course, is just a tad bit slower, but their GDP is still growing. The key is, as we progress through this year, do they have a hard landing, meaning a substantial contraction in GDP, or is it a soft landing? We're going to keep watching those data points. In the U.S., over the last couple weeks, things have stabilized a little bit. Retail sales were actually positive for the first time in 4 months. Unemployment claims were not quite as good, but not quite as bad as some of the experts want to say. So generally speaking, we're going to see how this month comes out on the initial claims and unemployment numbers, and we'll see if things start to get worse again. But things have seemed to stabilize just a little bit. Our global tactical opportunity portfolio is still invested fairly conservatively, although I look at the readings every single day. And if things hold true, and if the economy perks up just a little bit as we get through the end of this month, we will probably add back some equity-based positions. But what's interesting is one of our positions, which is the TLT, we've owned this for a while, which is the long treasury, basically hit a low point of about 138. Basically, the yield on the 10-year was down to about 138. Popped back up, and as of yesterday, it was about 185. Now we're seeing a big reversal back down today. In fact, we're looking at about 50 basis points that are going to be shaved off of that today from just on the opening. So something is in the reading, something's in the cards. We're going to see the Fed minutes that are going to come out today. My guess is they're going to say that the Fed's on the sideline, ready and waiting if things continue to get worse to basically jump in and do more quantitative easing. Although I don't think they're going to do anything today because the data is just not bad enough, in my opinion, and ultimately I think they don't want to do anything before this election, which I think is going to be interesting depending who gets in the White House, either for the second term or first term. I think this economy needs to get straightened out big time, and I think ultimately we can straighten this out, but it's going to take a lot of fiscal reform and debt reduction and really probably austerity type measures in this country, meaning paying out less and basically taking in a little bit more to get this thing straightened out. And of course, the size of our government doesn't help. This has ballooned to the biggest we've ever had in history. That also needs to be come down. But ultimately, we can revive this economy and we can grow again. But it's going to take adults in the room and discipline. And again, we're going to stay on the conservative side until we get through this end of this month. We're going to see what happens. And if we add back some equity-based positions, because the trends are basically going in that direction, and our relative strength indicators are dictating that we will do so. I will err on the side of caution, and we're going to follow our system and our investment strategy, because if you do not have one and you're flying by the seat of your pants. What's the most interesting thing that I keep hearing is that the stock market is at a 4-year high, the S&P, but they don't tell you that it's still down 15% from 10 or 12 years ago. Nobody will basically tell you that. So in 12 years, the market has gone nowhere but down, but they're going to celebrate that things are at an all-time high on the S&P. What's interesting is most of the return, in fact, about 4 to 5% of the S&P return has really been driven by Apple because it's capitalization-weighted index. If you go on other indexes, many are actually negative, down, or not up very much, other than the S&P and the NASDAQ, which again are capitalization driven, and primarily by the really good likes of Apple this year. What I fear is if Apple trips up, you could see a huge reversal in the S&P and the NASDAQ because there's such a high weighting in Apple. So just to kind of give you a little bit of history on how some of these indexes work. Again, if you have questions about your portfolio, you're a client, please give us a call. If you're not a client and want to become a client, give our office a call. We always like taking on new clients who are nice people who want to better their situation. Until this Sunday show, make sure you have yourself an extremely profitable week.